So right now I'm just kind of on the sidelines, just, building my war chest. And then when the time is right, I can deploy that capital appropriately.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point podcast listeners, to another episode of the Freedom Point. I am your host, Jeremy Dyer, and today I have a wonderful guest with me, Christopher Liu. Christopher is a doctor and a physician, PhD. He became financially free, get this, at the young age of 29, and he retired at the age of 38. Real excited to dig into how that became possible. From a high level perspective, he made a lot of strategic investments, back in the 2008 financial crisis. And he is currently the founder of Financial Freedom for Physicians. So without further ado, Christopher, welcome to the show.
Hey, Jeremy, thanks for having me. I'm really excited to do these, and I don't do these very often, but when I do, I try to provide massive value and just kind of, provide guests with inspiration, motivation, whatever they need.
Yeah, well, we really appreciate your time and jumping on the show to talk with us a little bit more about, kind of your own personal investing journey. So with that said, maybe can you kind of bring us back to some of those early, decisions that you made, which really kind of helped set you up for, a path of, financial freedom and really abundance?
Yeah, well, I got my financial freedom journey started back in 2002 after I read Rich Dad, Poor Dad. And this was right after the dot-com crash and right after 9/11. I realized that something was really wrong with the world. It was changing. And I saw the healthcare crisis looming. So I was like, I got to have an exit strategy. Regardless if I practice medicine or not, I have to start planning and preparing. And perfect timing. This was like when Bush dropped interest rates after the recession. This was when like kind of the real estate boom was. So almost everything was going up during that period. So, I made a lot of money trading stocks and options. I invested wisely. So I took risk, but I took my profits and I put them aside, invested in real estate. Again, perfect timing because Houston real estate was really cheap. To give you an example, a 2-bed, 2-bath condo, 1,500 square feet, was going for $50K. And these were renting out for like $1,500, $1,600 a month. And so it was like perfect timing. By the time I had medical school, I had about $250K liquid net worth, had 2 rental properties, and I had my financial freedom. And so the interesting thing is I go to my dean, it's graduation time, and he's like, what do you want to do with your life? And I was telling him what I'm telling you now. And he's like, son, put that aside, focus on your career, get into a high-paying specialty, and worry about that later. And that didn't really sit well with me because I was like, I have my financial freedom. What are my options? Can I start a company? But nevertheless, I took his advice, took the well-trodden path, mashed into orthopedic surgery. And I tell this story to all my audiences. I show up on day one to orientation, and instantly my gut instinct, which I have honed since I was a little kid, was like, this is wrong for you, this is the wrong path. But I stuck it out for 2 years. I invested so much time, money, all those exams. And I was like, it was really a miserable time. So luckily 2008 hit and all like the market was crashing, people were losing their homes. And that was my time to start strategically investing. So I went all in. I took a bet on myself, the biggest gamble I've ever taken on my life, but it's paid off huge. I'm 25 years plus ahead of all my colleagues. They're still in their jobs, paying off student loans. And I'm helping other physicians kind of transition, talk about financial freedom. I was able to retire early in 2016 as a result of strategically investing from 2008 to 2016 and just bread and butter approach to real estate investing, safe, single family. cash flowing properties. And I wanted to parlay that experience into helping other physicians because a lot of them are struggling. We've got a financial crisis, health crisis. We've got so many problems in the world, and I want to be part of that solution.
Yeah, absolutely. I appreciate you kind of sharing some of that background. So let me dive into a dig in, I should say, to a couple of things that you mentioned. One thing that you mentioned is that you took risks early. Okay.
Mm.
What were maybe some of those risks that you took early, and what were some of the things that maybe you did to kind of mitigate some of that downward that some of that downward risk really that existed in some of those decisions you made?
Yeah, wonderful question. Because now, like almost 90% of my strategy these days, because everything is so uncertain and unpredictable, I think about risk management more than I did back then. But back then, what I did was like, for example, leverage. If I took on leverage, I wanted to make sure that I was able to pay that off in the worst scenarios. No cash flow. If the market was down, you still were able to pay off that debt. So just kind of very very thoughtful and mindful that markets can go up and markets can go down, and what actions and behaviors and mindsets can I do to worst case scenario happens, I I'll be okay, and best case scenario I can come out ahead. So that's what I started thinking. I gave you an example of, for example, trading options. These days options are probably you make a profit, you have to take it off within a day or so because things change. But back then, if I had set off 20% downfall, get out of get out of the contract. If I made 10% in a day, kind of take those profits, set them aside, save it for always save for a rainy day. So those are kind of the mindsets. Just like, for example, real estate, kind of not overbuying for a lot of properties, which a lot of people were doing back then. They're basically just getting in and kind of flipping it, and that ended badly for a lot of them. So those are some of the kind of mindsets. And like risk mitigation is there's a lot of companies that have teams that look at risk. So it's kind of from a professional standpoint, but it's just kind of like thinking, okay, what is the upside, what is the downside, worst case scenario, protect yourself from the downside, come out even or come out ahead.
Yeah, Christopher, that's some great advice. I appreciate that. You had also mentioned at one point that you took some bets on yourself. So I know that sometimes when it comes to investing, all the education is really out there for free, and oftentimes it comes down to the individual, taking those action steps and kind of, getting past the analysis paralysis, right? So what were some of those ways that maybe, Christopher took a bet on himself early on when you first got, started investing in real estate?
Well, one thing is I hired mentors. So just either whether it was coaching, so there was people that had done what I wanted to do. So people that had followed the well-trodden path and had results. So I paid them to kind of show me what is possible. One thing is, kind of like I allude to, like kind of the naysayers or the haters, I really didn't pay attention to those because they hadn't accomplished what I hadn't done. So just paying for mentorship, paying for coaching, paying for education. Now we live in an age of we have information. There's an abundance of information. Before there was kind of like, if you had that information, you were at an advantage, but now we're in the age of transformation where you have to take that knowledge and apply it. So you have to have somebody to show it to you. You have to have real world experience. We've got YouTube, we've got Khan Academy, podcasts as well. Audiobooks, all of these. So kind of, I think for entrepreneurs, the best investment is in yourself, because that'll produce outsized returns, better than any stock or real estate. And basically you're continually growing. And I've seen just those gains over and over.
Yeah, that's a great point, Christopher. What you had mentioned during the kind of the period of 2008 to 2016 that you were mostly investing into single family properties. Was that a fix and flip type strategy? Was it a buy and hold and rent? And then, the second part of that question is, so from 2016 till today, what type of personal, real estate related investments have you been making? Have they been on the active side, the passive side, et cetera?
Yeah, so mainly just I like to my whole MO during 2008 to 2016 was to create enough passive income where I could do whatever I wanted to do, which is to help other people, which is and just kind of or to sever the ties between my time and my income. So income was coming regardless if I worked or not, and so that strategy worked. Um, so the reason why I chose single families is because one of the cost, and two was the ability to capital, and three was just the kind of the cap rates. The cash flow was there. So once I accumulated my 12, 13, 12 properties and cash flowed it, and I was sitting on a nice nest egg, and capitalizing on depreciation, tax advantages, all of that. So then a lot of my colleagues, they were like, oh, you can go into commercial, you can do multifamily apartments, but I wanted to focus more on helping other physicians as opposed to just building my investment portfolio. So real estate was kind of more of a means to an end. It taught me a lot of the business aspects of just running a business. Kind of, we talked about risk mitigation. The other thing is recently, at the tail end of 2016, I started to get into more passive investments. So, and just it's really say syndications, but that's not a large component, and that's just to have a just kind of a passive real estate approach. I own some REITs as well, and since I bought my last property in 2018, and that's been cash flowing. And I offloaded another property in 2017 just to kind of free up the time. But most of my approach since 2018 up to now is just a wait and see, just because of the amount of economic uncertainty. We had COVID, we have interest rate uncertainty, we have economic uncertainty. So right now I'm just kind of on the sidelines, just building my war chest, and then when the time is right, I can deploy that capital appropriately. So that's kind of where I am, and I built this podcast, a growing YouTube channel, going on numerous speaking stages, sharing the word.
Yeah, that's great. Let's talk a little bit about the physician investor that's out there today. What are maybe two or three different pieces of advice that you would give to that physician that's maybe putting in 40 to 70 hours, per week, crushing their day job, supporting, their patients, but they want to get started into real estate investing, but they're just not quite sure where to start?
Yeah, that's the physician cohort is really interesting because they have the income, but they don't have the time. So a lot of it is, so for example, there's passive real estate investing that's through syndications. There's a number of different ways. The other thing I've seen with physicians is that their spouse, they go full time in the real estate to get that reps status, and that way, one component of the family is actually being the entrepreneur and investor, and then the physician is actually have the stable W-2 income salary. Real estate is extremely attractive for physicians because of the just basically it's a sure thing, and it's a slow thing. So you make your profit when you buy and just hold, and you can cash flow it. You've got a lot of tax advantages. The problem is you don't want to be an accidental landlord or kind of inherit these bad properties. So that's where one spouse can kind of take over. The other thing is, sometimes I know physicians, they do this on the side. Like they kind of devote, the weekends to looking at properties in their area and kind of, using that capital as down payment, just kind of as a side income, nothing full time. So you can do that as well. So those are kind of the two options, mainly is how do you best manage your time to produce the best outcome with your clinical responsibilities.
You mentioned the acronym REPS. Okay, I don't want to just assume that our listening audience knows what you meant by that. The way that I understand that acronym is real estate professional status. Would you be willing to explain to the listening audience what it means to be a real estate professional and how that might impact the individual from a tax perspective?
Real estate professional status is basically to be considered a real estate professional by IRS, you got to meet specific criteria. So basically, more than 50% of your personal service time must be spent in real property trades or businesses, and at least 750 hours of service in real property trades or businesses per year. So if you can, like, if you're a physician, if you're like a full-time surgeon, you obviously can't qualify for that, but your spouse can actually do that. And so if you're filing taxes jointly, and your spouse qualifies for that, you can get extra tax benefits by being a real estate professional status. So that's kind of the general. Again, I'm not a tax advisor, but that's kind of there's other people that can speak more fluently on rep status, but that's kind of the general overview.
Yeah, I appreciate that. And thank you for the disclaimer. Neither you nor I are tax professionals, CPAs, financial advisors, et cetera, et cetera. So appreciate that. But yeah, you're exactly right. I mean, for those investors out there, where one of the, spouses could qualify as a real estate professional, I know full well, the types of tax benefits that could afford those individuals. I've even known of scenarios in which case one or the other spouse has decided to retire from active income to become a real estate professional to help offset the tax consequences that the working spouse continues to make in their day job. So really appreciate that. Are you in a position then where you're helping potential investors to actually analyze deals, whether that be single family homes that they're looking to acquire, or they're looking to be passive investors in a real estate syndication?
Well, great question, because I get a lot of requests, to help analyze deals. Like I said, real estate was more of a means to an end. So once I got my financial freedom and learned the investment, I didn't go any further. So I don't do any real estate coaching. I don't have any private syndications or any of that sort. But if the audience is interested, I can refer them to people that do that. And it's I'm not affiliated or anything, but again, this is not financial advice. So
yeah, no, I appreciate that. I know that you don't have a crystal ball, but I'd like to get your kind of opinion on where you think the market is headed. And I say that given the lens that you first got started investing in real estate back in 2008, and the time period between 2008 and 2016 were tremendous times, to invest into real estate. And the word on the street is that 2024 and 2025 are going to be great opportunities to get started investing in real estate. And I kind of wanted to get your own personal, perception of, where you believe the market is headed, in the real estate, industry. And specifically, I'd like to, have you speak to how you believe that's going to impact the multifamily space.
Oh, really good question. So, yeah, really good. I can't really speak on multifamily, but what I'll say is, so in general, comparison between 2008 and now. So 2008, you had the entire market was depressed. Everything, it was like a global recession. Now is kind of like you have little pockets of recessions, depressions, but you also have pockets of high growth. For example, a lot of areas in Fort Worth, Frisco, these areas, Austin as well. These are super high growth, people moving in. So what I tell clients now is now's not the best time to invest. It's also one of the better times to invest. So it's kind of like depending on where you are and what particular strategy may work or may not work. So you have to be more strategic in what you invest in. So yeah, the numbers have to work out. Again, interest rates are much higher, so your debt service is a lot higher. If you can acquire a property for good valuation and you can service the debt levels, then the numbers may work out. You may have to put a larger down payment, or just kind of buy a cheaper house. So those are kind of the ways to look at it. So, in terms of the overall market, it's really interesting because with COVID and with remote work from home, um, for example, the commercial real estate sector, I've been watching extremely closely because San Francisco, you look like New York City, a lot of these places are empty. So what's going to happen? Is there going to be another black swan event to cause a collapse there? We don't know. Right now, the with the Fed adjusting the interest rates, it's almost like kind of like a fine tune. It's like if they adjust it too high or too low, and so the economy can go either way depending on what how this it's all kind of like they're threading a fine thread through a needle. So that's how I kind of describe it. So and in terms of multifamily, like I said, I heard just industrial as well as storage. These are kind of doing well, but again, I don't invest in that, so I can't really speak to that.
Yeah, for sure. Well, you brought up the interest rate, challenge, and certainly a lot of the, uncertainty, a lot of the, pressure, that's being felt, at the sponsorship, level, across the board, is largely a direct correlation with, where the debt is at right now in terms of interest rates. And, so most certainly, we're seeing, valuations, down, across the board in the multifamily space, depending upon the market, location that the asset sits. We're also seeing definitely, not distressed assets, but distressed operators, right? The people that own the building. So, the buildings are going to be there, next year. But the question is really comes down to, is it going to be owned by the same individual or individuals, right?
Yeah.
So really appreciate that. Christopher, what's next up on your, bucket list, either personally or professionally?
So bucket list really, again, I've got 2023 was a really awesome year. 2025 or 2024, 2025. With the reason why is with kind of people are kind of looking at the interest rate is kind of sort of peaked at the interest rate cycle, and so just all our eyes are on the Fed, and so more than likely they'll keep interest rate the same or cut. Maybe a few adjustments upwards, but kind of we're at this peaked interest rate cycle. So that's going to be good for equities. That's going to be good for tech. It's going to be good for digital assets. Real estate as well. Again, depending on location and all of that. 2024, 2025 are going to be really great years. Ramping up the podcast, with artificial intelligence, I was able to 7x my podcast results. We've got a growing YouTube channel. Check that out. We've got an email newsletter, blog. We're putting out content. I got several speaking engagements around financial literacy coming up, and it's going to be a banner year.
That's great. For the passive investor that's listening to the show today, what would be maybe one or two book or podcast recommendations outside of our own that you would potentially recommend to the listener?
Yeah, well, I like right now a lot of the podcasts I'm listening to are more in the digital asset space, so it may not resonate with the audience or listener. But some of the really great books that have come across is one is called The Fourth Turning. And this is fantastic. They accurately describe in the they accurately describe exactly what is happening today, just in terms of just the changing world order, the rise of China, the rise of India, the rise, kind of countries divesting away from the dollar. Global debt levels are at an all-time high. Countries printing currencies, devaluing the dollar. You got populism. You got technology as well as artificial intelligence. So check out those books. It's The Changing World Order by Ray Dalio, as well as The Fourth Turning. They explain exactly what is happening in our society today. And just what I saw in the early 2000s, it just captures everything. We now live in this information age, and the internet has changed everything, social media. So definitely check out those books. Like I said, podcasts, I'm listening more to, I got into, again, this is not a financial advice, but I got into Bitcoin back into 2012 just as a speculative play, and it's done very well. So I've been trying to understand the asset more. There's the spot ETF coming up. There's the halvening, and it's a really interesting asset class to kind of learn and understand and kind of mitigate yourself against the risk of central banking. Again, this type of investment is not for everyone. It's extremely volatile. So, but I've been listening to the Bitcoin Standard podcast. Can check that out. Again, if you don't understand something, don't invest in it. So that's my caveat.
Yeah, I wholeheartedly agree with that 100%. I regularly tell, potential investors and existing investors, you've got to do your own due diligence. All the education is out there. You just have to take the time, to go do your own research. You've also provided me with a plethora of resources to dive into. I have read the book Changing World Order by Ray Dalio, so I appreciate that. But you've also provided me with a couple of additional resources that I'm going to most certainly check out. What would be maybe a couple different ways that our listening audience can connect with you to learn more about what you're up to?
Best way, email me at Chris, is CHRIS, at drchrislu, MD-PhD.com. And then my team will get you plugged into the ecosystem. We've got an email newsletter. We're on Substack. We've got a growing YouTube channel, podcast. You can check out the podcast in YouTube. It's just type in my name, Christopher H. Liu, MD PhD, and they'll show up. Yeah. I'm on Twitter, TikTok, Instagram, Facebook. We've got a growing community. So
that's great. Well, you're everywhere on social media. And just for the listeners here, Lou is spelled Loo. So just wanted to make sure I highlighted that out. And we will most certainly put the links to all your different social accounts in the show notes. So Christopher, I've really appreciated your time today and the value that you brought to our audience.
Excellent. Thanks, Jeremy. I really appreciate the questions.
Absolutely. And listening audience, thank you again for joining us on another episode of the Freedom Point podcast. We look forward to having you on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.